Welcome back to Capital Connection. Thanks for staying with us on the show. David Costa is standing by, Dean of Robert Kennedy College, who's joining us live from Zurich. Thanks so much for coming to see us today. Now, let's talk about the US debt ceiling issue. I believe that you are confident that this will be resolved, but surely some damage has already been done, at least from a confidence standpoint, by the wrangling that's got us to this stage in the US.
Absolutely. Very good morning to you, Becky. I think the confidence damage is there. It was totally inappropriate to carry on this discussion and really play Russian roulette with such an important issue, which could be a possible default, which would have a catastrophic result for the whole world. So I think the confidence, the idea of going back to the fear is just there, and we can see it with gold and some of the other commodities. So investors will take some time to get back into the markets, into a risk mode, because at the moment the sentiment is still pretty much a wait and see.
So you believe that even if we do get a resolution to this debt ceiling problem, that investors should continue to factor in that it's going to take a while to get back to normal? Is that what you're suggesting?
I think if we look at the US, I'm at the moment isolating for a second the problem with the debt ceiling, which I do see as a non-problem, because they will find an agreement, in my opinion. I'm more concerned about the data which we are waiting now. I'm also concerned about the unemployment, and I'm concerned about how do you really go and increase growth in a situation where you have so much debt. And that's really necessary to see. So we need lower unemployment, and we need to recreate growth in a situation where we still want to cut spending. So in a way, Europe is a step ahead, because in Europe we already started to cut spending and we already increased the taxes, something which I haven't been doing in the United States yet. So that's why, looking at the US market, I'm still concerned at the moment, even if the debt ceiling is raised.
David, a lot of people, investors flying to safety using gold, investing in gold, investing in the Swiss franc. What do you make of these two? Are you still bullish on these two?
Well, if you are an investor in Swiss francs and you had invested in gold a year ago, you will still be slightly in profit. But if you had invested at the beginning of this year, despite gold being so high in US dollar terms, you will still be at a slight loss. So I think gold is seen by many investors today as a real currency. And that's why thinking in terms just of a simple commodity is not appropriate. So I do see gold higher by the end of the year because of the uncertainty which will still continue. I don't see any major surprise that could strengthen the US dollar in the next 6 months. So for that reason, I also see many private banks in Switzerland increasing their allocation, starting to add gold in their asset allocation, in which many clients don't have yet. So I do see still positive way for gold till the end of the year.
How much higher do you see gold heading, David? It's now 1,600.
Well, it is very difficult to make a prediction, but I would say 1,800 is very much possible by the end of the year. And if the situation doesn't improve globally and we still have fear into the market as we have today, we could well see 2,000 on the next year.
David, let's talk about some equity market investments. There's a sector that has really caught your attention, and those are the luxury goods, right?
Yes, if we look at where to hide this year, the last two companies reporting fantastic returns, fantastic increase in returns are LVMH and Swatch just yesterday. So we see that luxury goods is one of the sectors which doesn't have any sign of slowing down at the moment. And since a year ago, have been really an incredible run-up. We have seen now also diamond company De Beers concentrating opening another store in Hong Kong. They wanted to open more stores in China by the end of the year because they forecast that the diamond consumption in Asia, including China, India, and also Middle East, will outpace the current #1 consumer, which is the United States. So I still see a market with a lot of potential, because pretty much China can produce anything nowadays, but one thing they don't want to reproduce, they don't want to do better, is luxury brands, because they benefit from these prestige and artisanal manufacturing, which you only find in Europe and by also some of the American producers.
Let's stay with luxury then, David. In the past, you've had some calls, some recommendations on other precious metals. If I recall correctly, one of them was platinum. Are you still bullish about that?
Well, platinum is one of those precious metals which didn't go up as much as gold. Actually, in terms of Swiss francs, it did pretty badly. Obviously, it is a metal which is more linked to the industrial usage, so that's made it a bit suffering. But if you were now to go into precious metals and you wouldn't want to go into gold, I would say that any precious metal which can be physically stored, like in the case of platinum, we have an ETF here in Switzerland storing physical platinum, can still have a run-up, but that is more linked to what is going to happen also in terms of industrial production. So I will still be bullish, but to a lesser degree than of gold.
OK, David, thanks very much for that. David Costa, Dean of Robert Kennedy College, who was speaking as the